Three of the most recognized companies on Earth: Nvidia, Apple, Tesla. Between them, they show up in more retail investor portfolios than almost any other stocks combined. Ask the people holding them why they bought in, and you'll hear the same answers every time. Nvidia is the future of AI. Apple is the safest company in the world. Tesla is going to own the EV market. All three of those things might be true. None of them are a reason to buy a stock. The people saying them almost never ran the one number that actually matters before they clicked buy. That number isn't the stock price. It isn't the revenue. It's the answer to one question. What does this company have to do just for your investment to be worth it? Most investors never ask it. We're going to ask it 3 times right now. This isn't a video telling you these companies are going to collapse. This is about something more useful. The gap between a great company and a great investment at a given price on a given day. Those are not the same thing. And that gap is exactly where ordinary investors quietly lose money on the stocks they were most confident about. Here's the framework. For each company, 3 things. What you're actually paying, what the business underneath looks like right now, and what that company would have to achieve over the next decade just to match a plain index fund returning 10% a year. That's the bar. If a stock can't clear it under realistic assumptions, you're taking on more risk for less reward. That's not investing. That's paying a premium to feel like you're doing something. Nvidia. The story is real. AI infrastructure needs chips. Nvidia makes the best ones. Data centers are buying them as fast as they can be manufactured. Nobody is arguing with that. But right now, Nvidia trades at roughly 25 to 30 times its annual revenue. Not earnings. Revenue. Most large established companies trade between 2 and 5 times revenue. Even beloved tech giants at their peaks rarely sustained above 15. Nvidia is sitting at nearly double that. Run the math. Nvidia's market cap is roughly $2.7 trillion. Revenue is approximately $96 billion. To justify today's price and just match a 10% annual return over 10 years, Nvidia needs to be worth about $7 trillion a decade from now. To support $7 trillion, even at a generous 20 times revenue, Nvidia would need to generate around $350 billion annually, nearly 4 times what it makes today, growing at roughly 14% every single year for 10 straight years. In a market where AMD is closing the gap, where Google, Amazon, and Microsoft are all building custom chips specifically to reduce their Nvidia dependence. 14% a year for a decade is not impossible, but it is the floor. The minimum required just to tie the index fund. Not beat it. Tie it. Apple. Apple is the security blanket of the stock market. The brand is the strongest on earth. The ecosystem locks you in. The services business is printing money. The balance sheet is immaculate. All true, but Apple currently trades at roughly 30 to 33 times earnings. You're paying $30 for every single dollar of annual profit. For a company growing earnings at roughly 8 to 10% a year, a premium growth multiple for average growth pace. And here's the structural tension most Apple investors never look at directly. Revenue has been essentially flat for 2 years. iPhone sales have peaked. Services are growing but under legal pressure across 3 continents. Vision Pro sold fewer units in its entire first year than some competitors move in a weekend. Run the number. Apple's market cap is roughly $3.2 trillion. At 10% annual return over 10 years, it needs to reach $8.3 trillion. No company in history has sustained a valuation above $4 trillion for any meaningful period. Getting to $8.3 trillion means Apple roughly doubles its share of the global economy. It needs a product category that doesn't exist yet, scaled to tens of billions in revenue while defending existing businesses from every regulator on Earth. Maybe that happens. But at $3.2 trillion today, that future is already priced in. You're not buying potential. You're buying a promise that already has a receipt. Tesla. Tesla is the most emotionally charged stock in the market. True believers and genuine skeptics in equal measure on both sides are louder than the math. So let's just use the math. Tesla trades at roughly 150 to 170 times earnings. The average car company trades at 6 to 10 times earnings. Tesla is priced at 20 times what a traditional automaker commands. The argument is Tesla isn't a car company. It's technology, energy, robotics, AI. Maybe. But right now, the actual revenue is still overwhelmingly cars. And car sales declined in 2024. First time since the company was a startup. BYD overtook Tesla in global EV sales and hasn't looked back. Margins have been compressed repeatedly through price cuts just to defend market share. Run the number. Tesla's market cap is roughly $1 trillion. To match 10% annual return over 10 years, it needs to reach $2.6 trillion. At a generous 50 times earnings by then, Tesla needs to generate roughly $52 billion in net profit annually. Today, it generates approximately $7 billion. That's 7.5 times growth in 10 years. 22% earnings growth every single year for a decade. In an increasingly competitive global EV market with margins under constant pressure. Robotaxi, energy storage, Optimus, real projects, real potential. But at $1 trillion, you're paying for a company that has already fully delivered on all of it. The price doesn't leave room for the journey. It only pays off if the destination is already arrived at. Here's what ties all three together. The mistake isn't buying Nvidia or Apple or Tesla. The mistake is buying any of them without asking the question first. What does this company have to do just for my investment to be worth it? Because when you ask that question, something shifts. You stop evaluating the company and you start evaluating the bet. Those are completely different exercises. Evaluating the company tells you whether the business is good. Evaluating the bet tells you whether the price is fair. A great company at a terrible price is still a terrible investment. None of this means these stocks fall tomorrow. Markets stay stretched longer than any rational model predicts. Nvidia could double from here. Apple could launch something that resets its trajectory. Tesla could execute on robotaxis in a way that transforms its earnings overnight. Possible. But possible is not the same as priced in. And priced in is not the same as likely. When you buy at a price that requires a miracle to justify, you're not investing in a company. You're betting on a miracle. Sometimes miracles happen. But you should at least know that's what you're doing before you hand over your money. 4 inputs is all it takes. Price, current revenue or earnings, your return target, your time horizon. One answer. What has to be true for this to be worth it? If the answer makes you uncomfortable, that's not pessimism. That's information. And information is exactly what most people skip in the 10 seconds between seeing a stock mentioned on social media and clicking buy. The number on the screen feels like a signal. Usually, it's just noise dressed up in a story you already wanted to believe. Run the math first. Everything else is just a headline.